Larry Haverty, he's joining us on the phone. He's a portfolio manager at Gamco Investors, a large shareholder of Liberty Media, and his global multimedia trust fund owns about 65,000 shares of Liberty. He's with us from St. Petersburg this morning. Larry, thanks so much for joining us. Scarlet and I out here in the newsroom going through these elements on this $1 billion bid. Scarlet made reference to it, the share in after hours trading higher than the 17 per share bid. What does that mean?
Well, I think it means that this is a good deal, and that maybe John's going to pay more. I think for our purposes that's somewhat irrelevant. I just think it's complicated, and we need to walk through what John's up to.
But he's going to pay more? How high?
No, I don't think he's going to pay more.
Okay.
I think the market has that wrong. But this is, I think, a brilliant move for John, and it's three-faceted. The first thing is what I would call the last retailer in Cleveland strategy. John's not a retailer, as you know, but Len Riccio stays with this company, and Barnes & Noble is the last man standing selling books. The book business is getting squeezed by electronic books. We all know that. But if you're the last guy around, you can make a lot of money because all the people come to you. So basically, he's paying, I think, around 6 times cash flow for the earning power of this. It will be very accretive to him, and he has a great guy in Len Riccio, who I've known for years, who basically created this business and is still highly energized to run it. So he's cut out his risk. Then you go to Nook. Electronic books are growing very, very rapidly, and there are two business models. There's the Amazon business model and the Apple business model. And Apple, in order to buy a book from them, you have to pay $25 a month to AT&T or someone for transmission. The Amazon has no transmission fees. The Barnes & Noble Nook has no transmission fees. Amazon's model isn't particularly friendly to artists. Apple's is, and authors, I should say. I suspect that when Malone gets in charge of this, he's going to put an author-friendly business model on this thing.
Larry.
And he's going to sell a lot of books. And
Larry.
The ability to cross-promote with his other assets is just mind-boggling.
Larry, this is Scarlet. I want to ask you, because John Malone likes his tax benefits, and people have suggested that there might be something attractive in Barnes & Noble for him in this respect. Are there any tax benefits that he can capitalize on here?
No, I think one of the things John likes is marginal profitability. And let's just use Sirius as an example here. Sirius, you pay $12 a month. Let's say you buy 5 Nook books, and then you get the ability to have a 2-year subscription at Sirius for $8. The incremental cost to John of that additional Sirius subscriber, I think, is somewhere around $1. So he pockets $7 of gross profit rather than $11 for a sub that he has to market a lot of money to procure. He has a lot of excess inventory for advertising on his cable networks. He can cross-promote the Nook and cross-promotion activities. He's not losing any revenue, and he's going to get incremental gross profits from each additional book sold on the Nook.
Larry,
and
what about the $17 share price?
I'm sorry?
What about the $17 share price offer? It's $1 higher than what Bill Ackman bid.
I think that's a fair price for the assets of Barnes & Noble.
Okay. Thank you. Thank you so much for your time. We appreciate it. Larry Haverty, portfolio manager at Gamco Investors, talking to us about the Barnes & Noble bid.